Let's bring in Jeff Kleintop. Let's talk about the central banks around the world. A little Fed chat here, too. He's the Chief Global Investment Strategist at Charles Schwab. Jeff, it seems like the tone so far from Kashkari mostly aligns with Powell. I mean, to kind of start off the conversation here at home, do you expect any of the language from any of the Fed speakers to push back at all on what we heard from Powell last week?
Dramatically. We know that the central bankers, the FOMC, are not of one mind. Actually, there's very few central banks around the world where everyone on the monetary policy making committee are in agreement about exactly what the next step is, or even the next step after that. But I think on balance, what we're going to hear from Fed officials is very much in line with what the chair communicated. And that's sort of the job of the chair, right? To synthesize those thoughts and communicate the consensus thinking, not necessarily that everyone is moving in lockstep. So yeah, I mean, we'll get these from time to time, right? A speaker on that's either far to the hawkish side or far to the dovish side, which could move the markets around. But I think overall, the balance of their statements will reiterate what Powell told us last week.
Okay. The other thing, too, is that it seems like last week, basically, or the last 2 weeks, call it, I don't know, maybe just the last 10 days, trading sessions, all the central bank announcements seem to kind of go over smoothly with the markets. The Bank of Japan being one of the major highlights a lot of folks were looking for. So are we kind of getting some of that agreement now in the opposite direction of where they had been going, the hawkish side for so long? Like, are we getting some, like, a little dovish surprises here and there, like the BOJ not going as aggro as some people thought, Powell kind of towing the line still?
It may be the case. You've got to step back a little bit, though, to see it. This morning we got a rate hike from the Reserve Bank of Australia, right? So, they hiked, I think, in February and March of this year, then paused, then hiked again for a couple meetings, then paused for 4 meetings, and then just hiked again. They're probably going to pause in December. What we know is they have a hard time with commitment. But if we step back from any individual central bank, we can look at the 115 central banks around the world that I track, and some certainly matter more than others. But taken as a collective, powerful force, we have already seen the turn from hikes to cuts as we look around the world. Investors, I know, are waiting for some of these signals, but if you really step back a little bit, you can see this. We've already seen this shift to where with dozens of major central banks already moving in the direction of rate cuts. Many of these are ones that led the major central banks, like the Fed, by 6 to 12 months when they were moving on the upside. I'm talking about Brazil and Chile and Uruguay and Peru and Poland and Hungary and a number of them, emerging markets, but they were first to hike and now are some of the first to cut. So I think what we're seeing here is a global shift already beginning to take place in the dovish direction.
It looks like from the chart, yes, our central bank cycles do move in pretty big swings, right? Like once they turn, they generally kind of turn. The exception going back from 90 to 98, basically. If we pull up that chart again, it's the left side of the chart. Pretty cozy, without many changes. What do you think, Jeff, is the historical precedent or insight we can get about the possibility of perhaps something other than like a massive downswing that looks the exact opposite like that last big upswing? Could we go sideways?
We could go sideways, or we could find that maybe there's a little bit more volatility. What we know is that inflation in this cycle is a little bit different, and we've got a very tight global labor market, something you don't see in much of this picture looking back, where we had an abundance of global labor thanks to China and others. So maybe a different economic backdrop, particularly as it relates to labor and the potential for more inflation. So that could change. There are also some central banks that matter more than others. We tend to think of the Fed as the heavyweight, and it certainly is. But the Bank of Japan is also very important. It's been dovish for so long that a change in essentially 2.5 decades of monetary policy with the potential for rate hikes next year could really cause a reversal in global capital flows that could upset the markets, even if the rest of the central banks head in a more dovish direction, because obviously there's a potential here for rate hikes by a central bank that has not undertaken any so far. And, Japan is interesting because it is, of all countries, it has the largest net international investment position, meaning that Japanese investors hold more securities around the world than any other country does. And so if that money starts to move home because the yen is more attractive or domestic interest rates are higher, that could really cause an unwinding of global capital flows around the world. And that would change maybe the pattern you might expect with a dovish move on this chart, because you've got one central bank that matters a lot potentially moving in a hawkish direction.
All right. Okay, so with all that, the Japanese yen still just like on this erosive erosion style chart. Jeff, you've got a really interesting chart that I haven't really seen it framed like this before. It's CPI, and looking at the number of months since headline CPI was last at the inflation target by that country's central bank. Walk me through this, because it looks pretty useful for us right now.
That's interesting. So this is looking at the last time it was within plus or minus 1% of that country's inflation target. Most countries have a 2% target. Not all of them do. But what we've seen here is, for example, last week, if you look at all the way over on the right, you've got the Eurozone. Last week's data revealed that inflation in the Eurozone fell to 2.9% in October. That's now within 1% of the ECB's 2% inflation target. There are only 3 other developed or emerging market central banks that are close to their target. However, after many months of inflation exceeding target levels, other major countries are also closing in on their targets. That little orange band there just shows how far they are away from their target. And the blue one shows us how many months it's been since they were within that range. So, I think what we're starting to see here is rate hikes are starting to end broadly as this gap narrows, and we're going to get close to an end to what has been many, many, many months, particularly on the left side of this chart, of countries where inflation's been exceeding expectations or exceeding the target range.
Yeah, it's really interesting. It does give some good perspective, especially on the left side there, where obviously our inflation numbers got so far beyond that target. It does kind of give us the perspective that if Powell means business about getting to 2%, there still is work to be done. We've got about a little over 2 minutes, Jeff. What else should we know about the global picture right now? I know you were looking at Euro data. What did we miss the past week if we were myopic here thinking about American data?
Let's think about jobs for a second. So last week, we got a relatively soft job report in the U.S., and that overshadowed a lot of the global labor data. But we're seeing broadening weakness everywhere. Last week, we learned that the unemployment rate in Germany rose by 30,000 in October. That was more than double the 14,000 predicted by economists. And we've seen now 9 months of rising unemployment claims are reported monthly in Germany as opposed to weekly here in the U.S. That's 9 months in a row of rising unemployment. That has pushed the unemployment rate up to 5.8%. That's the highest level in more than 2 years. We also on Friday got Canada's employment report. That was a weaker than expected gain of 17,500 jobs created in October. And there also a rise in the unemployment rate to 5.7% from 5.5. Next week, we're going to get the UK jobs report to see if it makes 4 months in a row of job losses. So we're seeing this deteriorating labor market globally. In fact, the Global Composite Employment Purchasing Managers Index, a good leading indicator of employment, fell to just 50.5 in October. That's just above the threshold of 50 that divides growth from contraction. So all this points to the global economic weakness finally impacting a lagging economic indicator like jobs, which could feed back into weaker consumer spending. Of course, tomorrow, we're going to hear from Disney and MGM Resorts on the state of the consumer going forward. After the Q3 entertainment and travel spending binge, we'll hear a bit more also on Friday for the University of Michigan here in the U.S. on consumer sentiment. So I think we might begin to see that weaker global job environment begin to cycle back into consumer sentiment and perhaps retail sales in the fourth quarter.
Hey, Jeff, excuse me for using the trigger word here of stagflation, but I was just moderating a panel here in New York yesterday about the topic, so it's on my mind. With unemployment rising in Germany, is their inflation sticky enough at this point to describe it that way?
I'm concerned about inflation in Germany, but it does appear to be coming down. Overall in Europe, inflation again down to 2.9%, getting closer there. A little bit more stubborn in Germany, but I think we are going to see that come down. German economy is very weak because it's so tied to trade and manufacturing, the two weakest parts of the global economy. So I do think we'll get a breakthrough there in the fourth quarter, see inflation come down. We'll be able to avoid that stagflation moniker for Germany.
Sounds like they're avoiding it by way of deflation, though, in a recessionary manner. So, great context.
Yeah, it's not necessarily how you want to get it, but that's how you do it. See ya.
Yeah, true. All right. A list of bad things. Deflation preferred to, I guess, stagflation. A good perspective.